The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. Thank you for being with us this evening. Good morning to our friends in Australia, and good afternoon to the team in New Zealand. Nice to have you all with us. How's the volume, folks? Would somebody type in the question box? Let me know you can hear me all right. Let's see. Who have we got? Yeah, Justin. First man, instant reaction, Justin. Thank you, my friend. Hope you're getting some rain down in the Hunter there. It's pretty bloody miserable, isn't it? And here's Dean. Great day from the Great White North. All good, good. And Chase, my friend. Thank you. And Chris also. Great guys. Okay, well, thanks for being with us. It's, boy, life's interesting in trading, isn't it? I mean, you know, we're supposed to take off, or we try to take off a week every quarter. I don't think we took off a week at all during 2017, and I mean, I just can't bring myself to stop trading in 2018. It's just been fantastic, particularly as we've starting to get some volatility in the equities now. Anyway, welcome everyone. We're particularly thrilled. Lots of usual friends here. Albert, Alex, Chase, of course, Chris, David, Harold, the king of the gold bugs in Redding, California. Delightful, delightful man. And particularly honoured to have Jerry Winter with us today. Jerry, welcome. Jerry's a long-time broker to the Daniel Code. He's done 2 or 3 at least, maybe more tutorials. And if you just look at the contact bar on the Daniel Code website, you can see Jerry's contact details there. John Chiwa, thank you for being with us. Justin, of course, Michael Pell over there, and God knows where. Michael moves around a bit. Mike Murphy, going to be a top trader, done a tutorial. Milton's waiting on the time signals, which I'm going to tell you about today. Peter, including Peter Battard. Peter's been, well, God, with us for years and years. Wonderful. Rob H. from New Zealand. Rob is a very, very canny analyst. Good to have you with us, mate. Lots of people, and particularly Sue. Welcome, Sue. Sue's a lady up in Cairns, Queensland, who traded for many years and never made any profits, and which is, you know, ups and downs, but generally not much or nothing. And she came and did a tutorial with me last year on the time tutorial, and she's doing so well now. She wrote me an email saying she'd more than doubled her account and paid for the tutorial and everything else, and was just enjoying. She said it's just such a nice change to be regularly making money trading Daniel Code time signals. So Sue, thanks for that in particular. Great to have you with us. And Tom, the king of the wealth managers, I'm not to say hedge fund managers, wealth managers. Tom's down in Florida and sticks with us pretty well. Thank you, Tom. That's great. Trevor, nice to see you. Okay, let's move on. And boy, trading's just been so great, hasn't it? We had sell signals, as you'd know, in all of the equities for me last night, for your today, and they turned nicely. Very, very important position the equities are in at the moment, and I'm going to deal with that a little bit later for you. Okay, let's move on and talk about the trading game. Now, some of you know all this stuff, and you'll just bear with me, if you will, that when we're trading futures, they're sometimes derived from underlying things, i.e. equities. When you're trading futures in the equities market, the Dow or the Russell, the Nasdaq, what have you, what's determining those prices is actually the prices of the equities that are making up that index. So these are derivatives. We're trading. Our futures contracts are actually based on what other people are doing with their buying and selling of stocks. In commodities and Forex, it's much more direct, Forex in particular. But equity is far and away the most important instrument in the financial market system. And they're constantly manipulated in subtle and not so subtle ways. You may not know that the exchanges have their own rules, or the sponsor, Russell or Standard & Poor's or Dow, the sponsors of these indices, make their own rules which are set out. They're quite transparent, and these shares that are in the indices have to maintain a certain price, and in some exchanges there also has to be a certain amount of volume. And when they don't maintain that price, it's not reflected in the indices. They just simply get rid of them and replace them with the hot new thing. So stock market's a bit like a cauldron of very hot water, and as parts of it get cooled down through negligence, changes in technology, witness Kodak, that sort of thing, they're replaced with the hot new thing. So they're always pouring some hot water into the indices, which give them this big left to right rising pattern, which is the basis of what all stock and share brokers tell their clients. Have a look at this chart. The market always rises over time, and there are huge incentives for investors to be involved in stock. It's government policy in the Western world that as much money as possible should be in the stock market. And there are all sorts of reasons for that. There's indirect benefits like capital raising, new projects, new expenditure by companies. There's direct government funding when you talk about T-bonds, T-notes, government instruments. That's you, the public, one way or the other, buying the government's debt with a guarantee of some certain return and a date of maturity. And everyone accepts that the government's not going to default. So that's why bonds are a blue chip, gold-clad investment until they're not. So we're talking about that, these general nature of stocks, though, the stock market, the share market, is that there are all sorts of penalties mitigating against trading of stocks. You start trading stocks, you immediately attract capital gains tax on them. And the whole theory of investing as opposed to trading is quite different, relies on the left to right rising market. And the always rising market hypothesis depends on rising real value. Many of these stocks are great companies that do create great value for their shareholders, but also they're helped along a bit by creative accounting and stock buybacks. Standard & Poor's came out this week and said over 40% of the big rally in equities has been caused by stock buybacks, 40%. It's absolutely staggering if you think about it. But anyway, the primary function of stock market is capital raising. Secondary functions are to reward shareholders, and probably well before they get to that, it's to reward officers of the company. Now, big trends. This is the Dow. You've all seen this chart before. This is the whole run-up from March 2009 up to the present. And as you can see, these blue lines are standard deviations. They're not your normal mathematical standard deviations. Oh, Terry Roberts has joined us. Terry, welcome. I guess you're down in Melbourne. Lovely to have you with us, my friend. Excuse me. These are not your standard deviations. These are Daniel code deviations. They're quite different. But the thicker blue line along the middle of this chart is the median of the prices, and the lines above it and below it are standard deviations from the mean. And you can see with the Dow, 1, 2, 3, 4 standard deviations from the mean is where it closed at the height of this current rally. And this is the picture that stockbrokers always showed their clients. Markets always rise. And over time, that's true. But the problem, of course, is timing. If you look at the charts and say, I get in at the bottom and I get out at the top, that's pretty handy. But the reality is life doesn't work like that. People retire, they need to free their capital, they have other requirements for capital, they get ill or unable to work, or all sorts of reasons people need their capital. And of course, markets are not always one way, and when they're on the way down, if you have to get out, if you need that money, you're in trouble. And of course, naturally, there's a pain threshold. How much pain can stock and shareholders bear? I'm always amazed by how much. I mean, I'm going to show you an example where a friend of mine, who's the vice president of Wells Fargo, was running a big book of clients, and he had them stay long all the way through the 2007-2009 crash, and he was having nightmares at night every time the phone rang and another client wanted to bail, and he said he kept most of them in, and he thought that was terrific. Well, you know, it was terrific, but depends on the time. If you needed to cash out 3, 6, 12 months after the low, it wasn't so terrific. So there's always a spin in trading, isn't there, and in investing as well. So valuation of stock starts with self-valuation. That's the publicly available information massaged by directors, and then controlled in an incomplete manner by auditors. Auditors are somewhat malleable. They rely on information provided by first staff and then directors. They do some checks, but you know, they don't actually understand. The vast majority of them don't actually know what's going on in that corporation. And that's why obligations of directors, like signing accounts and swearing that they're true, are so important. But there are some people, of course, that doesn't affect them anyway. But there are a heap of different treatments of valuations. You think of these GAAP, General Accepted Accounting Principles, the alternate that you're given. Great one going on now in Australia is a company called Blue Sky. Those of you who are old enough will remember the cartoons by Pierpont, I guess probably 20, 30 years ago. And Pierpont was a great one. For his investment company was called Blue Sky Investments, and it was anything but. And the present new Blue Sky company in Australia had assets under valuation of I forget the exact detail figure, but say it's $3 billion, and a US firm called Glaucus, that's a specialist short seller, came up with a report in them and said, well, you know, they don't have $3.5 billion of assets. They have less than, they might have $1 billion of assets, and it's since come out that these guys have been valuing their investment assets. They're a fund of funds sort of thing. They get fees from investments they manage. They have been valuing all their real estate assets at net current value pretty optimistically, I guess, although all property valuations are up so much, I guess you don't need to boost them anymore. But they'd been totally ignoring the liabilities against those properties and charging those fees. So, you know, if you think that sort of thing's exciting, think about what's going on in the big banks. We're having a peculiar moment in Australia where we have 4 big banks, or 4.5 big banks, if you like, the 4 major banks, Commonwealth, National, ANZ and Westpac, are protected by law from merging or takeovers. It's a very strange thing. And the government also guarantees accounts with them up to an amount of $250,000. So they're very privileged people. There's no direct competition to them. The companies, the American companies that have tried to get a toehold in Australia, Citi, a number of others have not been successful, and these four Australian banks, called the 4 pillars, are totally and utterly dominating the equity index here, which is called the SPI, the share price index. So it's actually the S&P 200. But these 4 companies between them, plus a couple of other semi-monopolies, control their net worth is 57% of the whole Australian market. It's staggering, but these are dividend-paying companies working in a quasi-monopoly situation, and their profits are actually staggering. And everyone wants to buy them. They're in everyone's superannuation fund, retirement fund, 401 equivalent for you folks in America. The government, under great pressure from the opposition, has finally got around to having an inquiry into them, and it's a very, very limited inquiry. It's not the sort of in-depth inquiry that'll go on and on, the usual government trick when you're forced to do something. Minimise it, make the terms of reference tight, and make the length of it so short that they've got literally no time to conduct a full in-depth inquiry. When I said we're 4.5 of these, there's another company called AMP, Australian Mutual Provident, which is a quasi-bank. It started off life as an insurance company, probably the most beloved company in Australia 20 years ago, all over the country, everywhere, greatly trusted. But so the banks and the AMP have been up before this Banking Commission of Inquiry, and it turns out that they've been very, very naughty boys, much worse than we think or know. It turns out they've been flouting the laws of disclosure. There are all sorts of matters they're supposed to be reporting to the regulator. They haven't been doing that, and their wealth management. But forget the big side of banking is the wealth management. You'd be interested in this particularly, Tom. They've admitted to having all sorts of charges for services, and the services are nil. They haven't provided the services, but they've been charging people for them. And they've had an absolute ramshackle arrangement with introducing middlemen, some of whom have been owners of gyms and owners of cafe. And if you've sent your mates along to the bank and they took out a home loan, you got paid commissions, startlingly big commissions. Of course, this has been abused absolutely, and we're getting to a situation, it's not specifically clear yet the dollar amount, but it may well be heading towards $1 billion or more of liar loans, or what you folks in America will remember as ninja loans, which was subject of great drama and amusement, to me at least, during the 2007-2009 crash. And it turns out that these much hallowed Australian banks, fully supposedly regulated, senior staff are getting paid anything from 2 to 30 million a year. Absolutely extraordinary, and they've turned out to be a total bunch of scoundrels. That might be putting it too highly, but there's no doubt that their wealth management wings have been so bad. I think they'll have to get out the business. I mean, there's just been one scandal after another, and I mean it's extraordinary. You know, I mean, I'm an attorney. I don't practice anymore, but I've been an attorney for 50 years, and I have some understanding of some of these regulatory bodies, and you just wonder what they've been doing. I mean, it's I don't know. It's like the PFG thing on steroids. I mean, where were the auditors? What didn't the auditors know? And the answer is a whole lot. Quite extraordinary. So this just showing you that, of course, their share prices are getting walloped, and not as much as Blue Sky, which is down about 50%. But they're audited by one of the very big companies. Same with the banks; they just don't know. They give the certificate, but they don't actually ever really know what's going on inside those businesses. So lots of drama and scandal coming out. Yes, Rob, CEOs walk free with millions in bonus shares. Absolutely. There just doesn't seem to be any accountability. None of these guys ever seem to have a significant, the fines that are made are just so irrelevant to the income that this is gaining. It's just meaningless. And as Rob says, no one ever goes to jail. But it's quite extraordinary. Look, it's not just mismanagement, it's scandalous. The senior management's been aware of this. There's absolutely no way it can be justified, and I'll bet you no one goes to jail anyway. And, of course, the rorts that have been going on. Words fail me, and I'm not often failed for words, folks, but there you are. Suhasini's joined us. Nice to have you with us, my friend. Suhasini's going to be starting a Daniel Code tutorial next week. Very nice to have you with us. Okay, so tax treatment, off-balance sheet transactions, they're the big swingers. optional consolidation. Companies have all sorts of partial interests that they may or may not have to consolidate. Now, I was actually chairman and a director of 2 Australian public companies before I was 30. So I know a bit about it, and I know what does go on and what can go on. But I can tell you, when I was director of a covered company, that's 30 years ago, and the oversight and the various authorities who get funded also with hundreds of millions of the Australian taxpayers' money hasn't got any better. You think things are getting better? They're not getting better. There you are. Okay, so talking about investors, I mean, a subset of investors are speculators. You know, they clamour to get placements in the IPOs. Those of you who follow these things, I mean, there's some amusing ones like Snap. All the young kids who use Snap, I don't even know what it is. I mean, I don't have a Twitter account. I don't have a Facebook account. The company has one that Terry occasionally posts to, but I've avoided all of that stuff. I mean, A, because I don't understand it, and B, because I don't see its worth. I mean, allowing the great unwashed to comment on anything just leads to stupidity, in my view. The Snap IPO, they ran this thing up to $27, $29. I mean, have a look where it is now. What Terry knows all about Blue Sky. Share price has dropped from $14.99 in November 2017 to $3.85 as of today. Thank you, Terry. You're all over it. That's wonderful. Thank you. Well, there you are. That's the one I'm talking about. Terry's very knowledgeable and knows all the details. So, you know, a lot of investors are actually speculators, and some speculative fever bouts eventually become justified. Look at the FANG stocks and Microsoft. They've turned out to be very dominant and very profitable businesses. Others may or may not justify that hype. I think about Tesla at the moment and, of course, cryptocurrencies. You just don't know, but the hype and the media just drives it on and on. And I suspect, you know, when some of the froth comes out of these markets, which I think is happening now, we're going to see some pretty amazing things going forward. So spec fever based on anticipation of future value is indeed a powerful incentive. So investments in equity markets, the granddaddy of retail investing. I mean, why am I talking to you about equity markets today? Because they're exciting again. They've come back. We've got volatility. I was speaking to Jerry earlier this week, and I was talking to him about how different the markets, equity markets, are now that there is volatility. Equity markets over the last few years have been fabulous vehicles for investors, but not great vehicles for traders, for future traders, because it's been all one-way traffic with, you know, counter trend every 3 or 4 days. But the volatility we've had since our friend Mr. Trump arrived has been simply fantastic. For equities, of course, the markets will always rise based on good management, increases in productivity, gains in technology. But while this always rise hypothesis is largely true over big time frames, the timing of entry and exits by individual investors, which is largely controlled by outside forces. You know, you might make an investment today thinking it's going to be a very long term. You might get sick. You might have to retire. You might change that time frame investment or something worse. It's going to be painful when these markets turn. It's going to be painful for everyone else, not us. We're going to love it because markets, of course, pay us exactly the same going down as they do going up. The good news is they seem to go down a bit quicker than they go up. And don't forget that governments are hugely invested in markets. That's why we see bailouts and guarantees when big corporations get into trouble. So you can see big trends in equities, bonds, and Forex. And these are all markets that are, to some extent or other, manipulated by governments. Equities are very, very dependent on the Reserve Bank, Federal Reserve discount rate, Reserve Bank in Australia, Federal Reserve, where you folks, most of you are, and endless liquidity and very suppressed interest rates. That's the fuel for equities. Bonds, you're funding the government. If you look at this chart goes all the way back to 2000. It's been on literally a consistent one-way tear for 17 years. This is the first time, in fact, since 2014, it's dipped below the one standard deviation from the mean. And the earlier ones that you see in 2005, 2007, 2009, they were actually above that mean, because this the first and second derivations of standard deviation alter as new bars are added to the chart. They're not a static thing, but the last time the markets closed below one standard deviation from the mean was in January 2014. It was only there for, this is a 24-day chart you're looking at. It's virtually a Daniel Code monthly chart. It closed for 1 month below that level. And you can see it's now been 1 month and then a rally, and it's fighting to hold above that level now. It's likely to have a couple of closes below that. So that's the influence of government. Here are the big trends in Forex. These are results of government policy. This is the euro-US dollar cross. So from 2008 down to late 2016, very early 2017, the trend of this market was consistently down. The euro was weakening against the dollar. Look what's happened from the beginning of 2017. The whole picture is reversed. The dollar is strengthening against the euro. Now, an old friend of mine always used to say, always look at these things on the cross rates. And if you look at the US dollar index, which is made up of a basket of currencies, it's very much the opposite of this picture. But anything there is government input, and there's more government input to most of these markets than you realize, is subject to big trends, because governments cause those trends with their policy settings. This is an interesting chart. I can see it's changed for you now. The chart on top is COMEX Gold. They're still working on the 24-day charts or monthly charts in Daniel Code equivalent. And the chart at the bottom is the US dollar index. Now, have a look at the inverse correlation. At the highs of these markets, which is back in 2011, gold's at its all-time high. US dollar index is very, very low. That's close to its all-time low. Since then, gold's run off all the way down until January 16. US dollar index has gone up. It's not an exact match, but it's close enough to rank at a pretty high correlation. US dollar index went a bit higher after gold had bottomed. Gold made its turn on a minor cycle in the US dollar index. But since then, you see gold rallying all the way up to now. It's a weak rally, but it's still a rally. And you can see the US dollar index is sliding away. So gold and the US dollar index have an inverse correlation. In other words, dollar up, gold down, dollar down, gold up. And the control is not the one that's subject to market forces, it's the one that's subject to government policy. Trump actually talked about this while he was campaigning. He's the only campaigner, the only person who is campaigning on either side who has any understanding of how important the exchange rate is to both manufacturers and importers. And he talked about it bemoaning the strength of the US dollar and wanting a much weaker US dollar. Since then, he's talked about it more since his election. Mnuchin, the US Treasurer, has come out in a slip of the tongue and stated, yes, we have a weak dollar policy, and then, of course, he immediately had to reverse it because of all the things that are tied up with the US dollar being pretty much the reserve currency of the world, and particularly its interaction with the crude oil market, the so-called petrodollar market. But you can see here, one side of these charts, one of these charts is controlled by government, the other one reacts. So this doesn't happen all the time. I wrote an article about this some years ago. There are periods when this correlation breaks down entirely. But when this correlation's in force, it stays locked in for a very, very long time. You can see what I've shown you here is everything since the peak in May 2011. So that's getting on for 7 years of data in these charts now. And you can see this inverse correlation. Dollar strength equals gold weakness. Dollar weakness equals gold strength. It's interesting stuff because it's a reality, and you want to keep in mind these really big trends when you're trading. They don't affect your day-to-day trading for reasons I'm going to show you, but they're still real. Talking about equities and buy and hold forever, a very good old friend of mine, was very keen on the Daniel code, a very elderly man. Not sure if he's even around anymore, but he was a vice president of Wells Fargo. And during, this is the 2007-2009 bust in the S&P. He was just being driven mad. He was driving himself mad too, because all his clients were fully invested. And the only policy, and that's the senior vice president of Wells Fargo, the only advice he was getting from the bank's investment division was, make sure your clients hold, make sure they hold, make sure they hold. And as it went down, it started to change to, this is a great buying opportunity, this is a great buying opportunity. And yes, it turned out to be right. I can remember when that low came in, we forecast that low at 666 on the index. We had blue line buys, everything else happening. And I was actually running a tutorial in Taupo, New Zealand that weekend. And I can remember this gentleman calling me, and the absolute relief, this was, a few weeks after that low, the absolute relief. He was just like, John, they've nearly killed me every night. The phone. He said, I went grey a long time ago, but he said, no, I've lost the rest of my hair. So it's not all beer and skittles, and this is just a market correction, as it turned out. And it's going to be pretty interesting what comes next for us. This is the US dollar index. See how we're just looking at all these very long-term charts here, the big trends. Here's this same thing we looked at in the previous chart. Here's the May the 11th up to very end of January, early February 2017 high. Trump's inauguration, Mnuchin as the new treasurer. What they do, the very first thing they did is set to work to weaken the US dollar. It's a very important thing you don't understand. No one's come out and told you that this market's gone from 104 down to 88 something. So let's look at that as a percentage. So that's 104 minus 88. Bear with me, and so that's 16%. So all of you who are holding US dollar assets and you think the market's gone up, which it has, don't forget the real net present value has gone down by 16% because your dollar holdings have all gone down by 16%. So, this is great for exporters. That's what a weak currency is designed to do. It makes exports cheaper and imports more expensive, so the consumer gets it in the neck. But the US government, like the Australian government, are both very, very much businesses, political parties that exist primarily for the benefit of big business. You can see the percentage of benefits from the recent tax cut in the US. Vast majority of that, 83%, flow to the really big, super wealthy people and corporations. In Australia, the Liberal Party, our Liberal Party, is in fact the equivalent of your Republican Party. There's nothing liberal about it. The other part of our political game here is the Labor Party, which is equivalent to your Democrats. But the Liberal Party had to be dragged kicking and screaming to have the most tiny, non-deep investigation into the big Australian banks. And it got to the stage, actually, that one of their own members was going to cross the floor. We have a very strict party system in Australia that when you are elected, you stand as a member of a party, Liberal Party, Labor Party, or one of the smaller parties. And there's a whole lot of discipline imposed on you by the party whip. It's the Westminster system, and it's not terribly clever, but we've inherited that along with a lot of the other foibles from the Commonwealth. And it got to the stage that one or more of the government only has in Australia only has a one-seat majority. One or more of the government members were going to cross the floor because the things that banks have done to individual clients, particularly the rural sector farmers, they've been totally unconscionable. And now all this other stuff's coming out. Why did the government resist so much that it was only when it was apparent they were going to lose the vote that they decided, let's get to the front of the queue and make it look like a procession? Why? Because big business is their constituency. The Liberal Party in Australia, the right-wing Republican equivalent party in Australia, exists for the benefit of big business. The opposition, the Labor, it exists for the benefit of big labour. That's why it's called the Labor Party. It's totally dominated by trade unions. And we don't have nearly as much trade unionism here as we did. I think trade union membership now is down to something less than 15%. I saw one report saying it was down to 11%. But the institution of trade unions are so powerful they control the other side of the political process. So, you know, you look at this and you say, gee whiz, the US dollars dropped 15%, 16% off its high. Why is that? It's government policy. Trump spoke about it during his campaign policy. Mnuchin, the treasurer, said, yes, that is our policy. We want a weaker dollar. Benefits our exporters. And then, of course, the day after, he had to say, oops, I didn't mean that. Of course, our policy is a strong dollar. So that's why there's a generally regarded rule that treasurers and financial operatives at government level never comment about exchange rates. And when they do, they usually put their foot in their mouth. But the benefit of looking at big trends and long-term charts is you can see what government policy is, because many of these instruments are directly affected. And so are some that you don't think are affected. I was about to move on and say commodities run entirely on supply and demand. Well, they do to an extent, but as you can see here in the chart on the top, that's crude oil. The chart on the bottom is the US dollar index. Now, they don't match perfectly, but you can certainly see there's been a very, very strong uptrend in oil since April 16 and after. You look what's happened with the US dollar. It's topped a little brief spurt up to its high at the beginning of February 2017, and as it's gone down, oil has gone up. Go back to the run-up in oil from the April 14th up, in the US dollar, I should say. As the US dollar had that huge rally from April 14 up until February 15, what happened to oil? It crashed. Okay? And because the vast majority of all oil traded internationally is traded in US dollars, there is what's called a D2 or deferred. D2 stands for derived effect. In other words, what happens in one market affects the other market. You don't think it happens in commodities, but it does. And it also happens in Forex. You can just about plot the Aussie dollar's rise and fall based on the price of iron ore. Okay, Trade Navigator doesn't have a chart for iron ore, but you can look at the rebar chart or the Singapore Exchange SX has a chart for iron ore, and you can just about plot the ups and downs of the Aussie dollar based on the price of iron ore. Why is that? Iron ore is Australia's biggest export, and the dollar earnings, apart from what the scallywags rip off with their overseas marketing hubs, quote unquote, are essential to the Australian budget. So important, in fact, that the movements in the price of iron ore affect the value of the Australian dollar. Let's move on next, see what we've got for you. This is big trends in futures and Forex. Now, for us, of course, the extent to which we can trade is margin. All futures contracts have margin, and Forex markets have margin as well. And I've just put these pink triangles on this chart, which is the S&P, to show you that margin, which is presently at 5,800, very high in the S&P, but it's generally historically somewhere between 3,400 and 4,000. But even at its present expanded rate, which is 5,800, you'll see I've got a 5825 there. Excuse me, I couldn't get the tool to just click on 5,800, but it did the first time. But that's the present margin, the S&P. That's it. If you're wrong in the trend, it doesn't actually take very much to start eating into your margin so much that you're going to get a call from your broker. So that's what controls what we can do. The base of that, naturally, we'd never risk anything like margin. You manage your risk by your stop loss orders, but the reality is sometimes stop loss orders are not filled where you think they will be. Sometimes they're not even filled very close to it. I remember during the .com crash, I had a group of young brokers who were trading along with me at one of the firms I was trading at there, and they looked at my account and got excited about it all and said, one of them actually rang me and said, I've just got a small group here, we're only playing with pennies, but would it be all right if we traded with you? We'll take your buys, we'll take your sells. I said, sure. It didn't matter to me. I thought, if all these guys are so interested in my trading, I might get a bit better service, but it meant nothing to me. And then one day, of course, don't forget, in electronic markets, your stops are filled in the order in which you place them. Okay, that's the theory at least. I know there's a fair bit of skullduggery involved with all of that, but leaving that aside, the theory is that in retail markets, your stops will be filled in the order in which you place them. So if you look at the Daniel Code Trade Program, whenever we give you an order, we give you the appropriate stop loss, and we expect you put the stop loss on at the same time as you put your order on. But lots of people don't. And during this big rundown of the crash in the .com era, I think Greenspan was the chairman of the reserve, and I had this group of young brokers who were trading away with me, following my orders, and they turned out to be much bigger than they told me. They said there were 2 and 3. Turned out at the end of the story there were about 30 of them between a number of firms. And anyway, one day during the trading session, actually very unusual this, during the trading session, Greenspan came out with an announcement that they were going to, can't even remember what it was. Well, I guess that's not surprising. It was 18 years ago, or 17 years ago at least. But he came out with an announcement, I guess, that they were going to cut interest rates. But he did this during this trading session, very unusual, about 11:30, quarter to 12 during the day. And the S&P rallied, just poof, huge, absolutely massive. My stops got filled with about 5-point slippage. Turned out the brokers, I'd said to them, make sure you have your stops on at all times. Oh, well, we're using whatever the tools were they used in those days. We can place our stops whenever we need to. They hadn't placed their stops until this announcement came out, and by that time they were so far away, they had so much slippage on their orders that they were wiped out as traders for quite a while. So there's just a side message apropos of nothing, but just to remind you folks, always put your orders on. This incidentally is the S&P. Interesting, I've done a couple of earlier tutorials showing you how all these turns in the S&P have come about at time and price, or what I call ping. I even wrote an article about it. It's on the website if you want to see it. And what we say here is when time and price are squared, a turn is almost inevitable. Now, I had a client say to me the other day, "Oh, that's one of Gann's things, time and price." Well, I'm a great Gann expert. I think I'm the most knowledgeable Gann expert in the world. I certainly spent more money trying to buy Gann's letters and original charts and other paraphernalia than certainly anyone I've ever heard of. And eventually I found out, of course, that it doesn't work the way it's supposed to work at all. But I spent 12 years being a Gann guy. And during that stage, I certainly found this statement of his, time and price. I've always said it's not original. Gann originally said when time and price are squared, markets will turn. But he had a totally different concept of time and price. What he meant by time and price was if the market was on one of his angles, he had angles that he drew all the time, 1 by 1, 1 by 3, 1 by 8, and then the inverse as well. We don't mean that. What we mean by time and price is when a market is at a known Daniel code number, and at a known Daniel code time cycle, then a turn becomes almost inevitable. And those turns, don't forget that the Daniel code says nothing about quantum. That could be something as simple as a 1-bar counter trend, or it could be a major turn. We learn that from trend, and how long that trend continues. It doesn't come from Daniel code signals. Daniel code signals are mute on quantum. But you see that high in the S&P yesterday, April the 18th, Wednesday. That bar there closed at 271050. And you can see the line on the retracement there, 271150, 1 point or 4 ticked variance. Now in a number like 2711, you multiply that to get the ticks, and we'd allow 0.1% variance as well within that. So we had a price recognition on Wednesday. We had time. We had a 59 cycle that was running from the outside bar 2 days before the February high. And that is actually a high before the high. That's where these time cycles typically run from. They run from highs before the high and lows before the low. So we had a 59 cycle expiring on that day. That's a known Daniel code time ratio. And we had price, which is valid at the bar high low or the close. In this case, it was the close, 4 ticks away from one of our retracement levels. And that gave us the TO3 sell signal for today, which I hope you all got. We tried to make the point pretty blunt. For today, we had sell signals in the S&P, the DAX, the NASDAQ, and the Russell. We couldn't be any much more clearer than that. And we got a turn. Now, very, very important to watch what happens with this bar. Thursday is historically a down day in the equities. It hasn't happened so often in the big run-up, a super fueled rally we've had, but over years, Thursday is typically the worst trading day for the S&P. Friday is traditionally an up day. So this bar that we have today is very important because so far as I can see, and I haven't really done a hell of a lot of work on it because I've been working on this webinar for you, it hasn't changed the trend. The trend is still up. So what happens today and Monday is going to be very, very telling. So it's time to really have your antennae up on these equity markets. Now remember, the signals can come in any market. Equity markets are so highly correlated that a market in any one of the 4 US major indices and Germany's DAX, a signal in any one can be executed in any other. So watch what happens, particularly with today's bar. There could be a precursor of a change in the trend. For us, of course, the trend is now up. And if that changes, of course, it'll be very interesting. Let's move on. What else have we got here? So because we're limited by some percentage of margin, we have to be far more precise in our signals. This chart, I think it's changed for you now, These are the website signals on T-bonds. You can see they've been pretty nice, and we've had almost all. I just think this chart starts. The first bar that I've highlighted there is March the 21st. We've had almost every turn up and down from the website signals. Now, the website signals are predominantly price. Okay, the TO3s have a small element of time in them, but they're still predominantly price. And you can see after the last daily buy, which is over here, I'll put the highlighter on to show you. Spotlight, I think they call it. Here's our last daily buy. Up it went, and then it reversed and went down. And we didn't have a sell signal up here. Okay? Why not? Well, there wasn't a time signal, there wasn't a price signal at that point. Those of you who know how to trade would have got it anyway because the trend is down. And so the trend has been down for 4 days. At this stage, you had a rundown from the original high up here. This bar turned the trend down it went. This bar turned the trend back up, but it was really a 1, 2, 3 bar counter trend. This bar turned the trend back down. So the trend is down all through here, and that means this bar here, I'll just give you a date if you want to match this on your own chart. That was Tuesday, April 17th. That's a 1 bar counter trend. And a 1 bar counter trend, you have to sell it to get back with the trend. So there are lots of reasons to sell it, but it didn't come up with a direct price signal. Okay, so absorb all of that, and I'll go back and get the other tool, and I'll show you what happens next. This next chart are the DC numbers. This is the chart from the members charts. What you should be looking at is how precisely these markets turn at the Daniel code numbers, which are not Fibonacci's. They're not old highs and lows. They're nothing like that. They're a ratio, a matrix of ratios that comes straight from market prices. The markets themselves create these price levels. And you can see here right at the high, you can't see because the chart's moved on a bit, but there was a blue line buy up here. Let me get back my highlighter. Spotlight, they call it. Down to here, okay, 144.24, that low. The low of that bar was 144.25. Okay, there looks to be a decent gap in there, but there's not. There's one tick. 144.24 was the Daniel code blue line. 144.25 was that low on April the 5th. That gives you price recognition or target recognition. If you look further down, you can see the fast stochastic. We use a special Daniel code stochastic, a 533. It's not your normal stochastic. We can see that was oversold. We can see we had divergence on our momentum indicator, and that gave us the buy signal in price. Up it went, and it rallies up until this bar here, which is April the 11th. Have a look at that high. That high is 146. Carat 28. That little arrowhead is actually called a carat. That's the old CBOT method of measuring markets by eighths. And this one has 4 eighths, 32 ticks and a point. That high is 146.28. The DC black line, which is the last level of support and resistance for any swing, is 146.27. Again, 1 tick variance. It's extraordinary, isn't it? Down it goes. We get down to this key reversal bar down here, which is made on April the 16th. The low of this bar is 145 carat 17. And you can see we've got numbers all around it. We've got 144.20 and 144.22. That turns it around and up it goes. And we get this 1 bar counter trend. This is a 1 bar counter trend. It hits the 50% retracement level. Then it goes down, trend continuation, sell signal, down it goes. Takes 2 days to get elected, it's a bit of a problem. Look where this thing stopped. This is a huge momentum move. And where did it stop? Today's low, 143.12. Daniel code numbers 143, Karat 13, both the black line and the blue line, one tick difference. These Daniel code numbers are magnets for markets. If you're not using them, you're missing out on a huge potential benefit to your trading, because markets turn at and only at Daniel code numbers. Extraordinary. Okay, let's have a look at this. These are the price turns in T-bonds for this period that I'm showing you, which is basically March 21 to date. Have a look at this. Very interesting. The first one, you get, bring back the spotlight. This one here, you have the stochastic substantially oversold. You have divergent on your momentum indicator. That gives you your buy signal, because we had price recognition here. You can't actually see that on this chart. And it runs right up to this high, and this high, which is April the 2nd, it had a high of 147.03. There's a Daniel code blue line at 147.06. That's only 3 ticks variance. And in a number like 147.06, 147 times, there's 4,700 odd ticks in that number, 32 ticks in a point. So that high, you had target recognition. 147.03 is the high. It's only 3 ticks off the Daniel code blue line. Look where the arrow is pointing down below it. Overbought on the Daniel code stochastic. Huge divergence on our momentum indicator, which is a proprietary indicator. That's your sell signal. Down it went. Down into this low here, which is April the 5th. We've already looked at this. The low of this, 144.25 against the DC blue line, 144.24. Look where the arrow is pointing. The stochastic is oversold. There's divergence on the CCI. The market has made a lower low, and the momentum indicator has not made a lower low. That's another form of divergence. That sets up the price buy signal. Up it goes. Okay, up into the high. You'll see the point of all this. Same thing. Target recognition, but look down below. Stochastic's not overbought. There's no divergence on a momentum indicator. Okay, there was a TO3 sell signal from that bar because of the small time element that is involved in TO3 signals. That was not only, for those of you who have done tutorials, that was not only a TO3 signal, it was also a DC hook trade, potential DC hook trade. And if that trade, if the DC hook trade and that low is taken out, the minimum target is this swing low down here. So look what happens. The market goes down. The minute it hits that swing low, okay, which it does on this bar here, which is 0416, it rallies. And you see this behavior with the Daniel code hook trades all the time. The minimum target is the swing low between the two highs. That's the minimum target. When the market hits that, it reacts. Doesn't mean it's going to have a change of trend. Does mean it's going to have a rally. 1, 2, or 3 bar counter trend. Maximum counter trend in a trending market is 3 bars. And you see this hook trade, target recognition, reaction pattern all the time. It never stops. 1 bar later up, 1 bar counter trend. We had the buy signal there. Here's your next trade. This is a 1 bar counter trend. You have to sell this to get back with the trend, but we don't have a signal for that on price. Okay, so let's see what does help us. How are we going to improve this? And the next chart, I suspect, will show you that. Here you are. This is exactly the same chart. This is T-bonds for exactly the same period. I've left the TO3 and plus signals on it. Blue line at the top, plus daily buy down. There's a plus buy signal. Look at what happens once we start trading time. Every single turn, we have a buy or a sell. No mistakes, no maybes. Trading time, once you understand how to trade time signals, they are a light switch solution. The signal is either on or it's off. Doesn't mean it's going to be elected, but you have the beauty about trading time is you have a new signal almost every day. You know exactly where to put your entries, where to put your stops. How often does it fail? Once or twice a year. The rest of the time, it's just like this chart looks to you. You have buys at the lows, sells at the highs, and it's extraordinary that these signals are now being generated. This is our time trading, which I'm teaching in tutorials and have been now for about, I guess, going close to 2 years. And the guys who are trading time, they're absolutely out of their minds about it. They're stoked about it, including Dean, who's with us tonight. And Dean, don't go away because I'm not going to embarrass you, but I'm going to I'm going to show folks to benefit from something that you did recently. So Dean's been a huge trader. He's an interesting guy. He took a fairly small investment in the S&P. As this is anonymous, I know you won't mind me telling him, Dean. He ran it up to $1 million. He's a huge trader, and now he's learned how to trade time. Okay, so that's the difference between price and time. Those of you who come to these tutorials regularly will know we've been trying to get this into a program for over 2 years. We've just about got it now. We're actually started testing, trading to test the program. I guess all of the bugs will come out in the next 3 or 4 weeks, I hope. Having said that, I give you the imprimatur that everything that ever happens to do with technology takes 4 times as long as the programmers have promised you. So don't hold me to that, folks, because I'm not the programmer. But we're very excited about having a program available that will create these time signals. Now, having said that, I have to caution you, anything that comes from a trading program will not be as good as the eyeball. If you're a trained Daniel Code time trader, you will exceed significantly the returns that any program will create. Now, when I say that, we expect the Daniel Code time trading program to far exceed anything else that's ever been seen on the market, but it will never compete with what the human Mark I eyeball for a trained trader who's done a Daniel Code tutorial. So for you guys, don't be worried about if you've done a tutorial, don't think that this is going to discount your edge. It's not. You simply cannot. It is impossible to write a program that encompasses everything that I teach you in the tutorials. Peter, am I taking these trades of the day or on the close of 3 ticks above below? You're taking them in futures 2 ticks above or below, and in Forex 5 ticks above or below, because there's no central exchange in Forex, so therefore prices differ somewhat. And these signals are created as soon as the market closes. So as soon as the markets close, the program or your tutorial will teach you how to create the signals for the next day. Pretty amazing, isn't it? Okay, time is moving on, folks. I've gone over time again. I enjoy talking to you so much. Do forgive me. Okay, so what have we got now? There must be something happening here. Here it is. Here's our next chart. This is the Forex chart. For one market. Don't know what that means, Sam. Tell me more. So you can do these signals for any market. They work for everything. Incidentally, someone's with us today who traded these. He did a tutorial. He's here with us today. And he traded Bitcoin on the Daniel Code time signals. He said he made $100,000 in a very short period of time. I don't know anything about that. I don't even look at anything to do with Bitcoins and funny stuff, but all markets turn at the Daniel Code. Okay, this is a Forex chart. I haven't talked much about Forex today, so I wanted you to understand everything I've said applies just as much to Forex. Here's our last TO3 and a blue blind buy signal in dollar CAD, and whoosh, off she's gone. Okay, what's next? This is the sell in Russell for today. Very important. I've told you about this. This is from members charts. We had a TO3 sell right on the high. Nice trade today. We also had the sells in Dow, NASDAQ, DAX and Russell. got the lot. Hope you did too. Filled your boots up. Watch very carefully what happens in the next 2 or 3 days. This bar is pivotal. Today's bar is pivotal for trend. If this low is taken out, it means there's a change of trend, almost certainly. Okay. Here we are. If you want to be a super trader and join the elite, email me with your name and phone number, where you live. Give me the location. I'll call you. I'll be happy to talk to you about your trading and what you can expect from a Daniel Code tutorial. If you are interested in this and you tell me you are interested and I prepare all the documentation, don't come back to me, please, 2 weeks later and say, have you got any other people and members that we can talk to? The answer is we have many, many members you can talk to. They'll all tell you that the Daniel Code tutorial is the best thing that's ever happened in their life. However, we are a private business. We do not advertise, and I am certainly not going to ask my members to tout to someone else for the purpose of getting business. So if you want to do the tutorial, you find us, you make up your own mind. That's how it works. I'll be happy to talk to you, but am I going to give you a list of people to ring around and get a reference? No, I'm not. You make up your own mind, and that's it. Okay, free trials, folks. If you haven't already had a free trial of the Daniel Code, you're very welcome to go to the website, www.thedanielcode.com. Click on the button. Get a free trial of 31 days of everything we do. If you haven't had a trial of Genesis Trade Navigator, I'm partners with them and have been for many years, and we'll be happy to arrange a 31-day free trial for you with the Trade Navigator software as well. This is the compliance statement, which is rather blurred because Microsoft, of course, have changed their PowerPoint packages. They seem to change everything every 10 minutes as far as I can see, but I do want you to be aware that trading is risky. You can lose a lot of money trading. You can also make a lot of money, but the difference is whether you know what you're doing or don't. Trained or untrained. If you're untrained, you'll probably lose your tail. Most people do. And that's about it for today, folks. I thank you for being with me, and I am so glad you've been with us. Now, Sam, I want to just subscribe to the levels and time for a particular market, bonds, for example. Is that possible, time and price levels? It will be, Sam. At the moment, the website only does price. Okay? I can teach you how to create the time signals yourself, but we will be able to be creating time and price signals. It may be another month or two away, so do please stay in touch, and we've got lots of exciting new products coming once we can get this program that's creating the time signals to work on its own with minimal supervision. We'll then be able to create time and price conjunctions on a huge range of markets. Okay, and that's it, folks. Thank you for being with us today. Thank you, MSN News and Mike Murphy. Thanks for being with us, guys. I hope you've enjoyed this webinar, and I look forward to talking to you again in the coming weeks. Bye-bye for now.